Today we're going to dive into an example case study of a couple who's 60 approaching retirement, and we're going to go through how their portfolio allocation and changes in that allocation can ultimately impact the success that you have in your retirement. So let's dive into it. Here we have Mark and Susan. Mark and Susan are both 60 years old. Today they're working. Mark makes $80,000 a year and Susan makes $65,000 a year. They have a 401k. Mark's 401k, he contributes 5%. He's matched at 5%. And Susan has a 403b. She contributes 6% and is matched at 50% up to that 6%. Going into their expenses, they have pre-retirement monthly expenses in the amount of $5,500. Now going into their net worth, we're leaving out their primary residence and other property. We can see here that invested they have $525,000. Mark's 401k has $275,000 in it, and Susan's 403b has $250,000 in it. If we dive into the retirement analysis, we can see here that as of today, they have a 98% probability of success. Going into their investments, we can see here that across all of their accounts, across their 401k and the 403b for Mark and Susan, they have a 70-30 portfolio. This is what we call a growth portfolio, with a hypothetical annual return of 8.9% and a standard deviation of 11.3%. And so what we're going to do here is we're going to go through how different allocations can impact their portfolio from where they are today throughout retirement. So we are not assuming a different allocation pre-retirement or in retirement. For the sake of this example, we're just going to use the same allocation because they're approaching retirement to show you how allocation changes can impact the overall plan. So if we go back into their retirement analysis, we can see here again that they have that 98% probability of success. So if we go into their asset allocation, again, we have what we call that growth allocation today. Let's just assume that we go to most aggressive. Changing that to most aggressive, which most aggressive is a 90-10 portfolio. We'll go over the annual return and the standard deviation in just a minute. We can see here that their median ending assets go from 2.2 million to 3.1 million. Going into their investments, we can see here that a most aggressive portfolio, we have a hypothetical annual return of 10.1% with a standard deviation of 14%. So what do we see here? We see a higher return, but we also see a higher standard deviation. What does this mean? Well, the riskier we get, it is more likely that we will deviate from that average return at a higher rate. So we will in turn have less stability within our portfolio. So let's go over what a most aggressive allocation looks like and the things that you need to be mindful of, the risks involved. So sure, while our annual return might be higher, we also have a higher standard deviation amongst other risks. Risks like sequence of return risk. What is this type of risk? Well, this is the risk that poor market performance in the early years of retirement will result in your portfolio being depleted prematurely. This ultimately leads to longevity risk. When you make withdrawals from your portfolio in a downturn, you must sell off a larger portion of your portfolio to get the same amount of cash. This leaves you with less capital overall in your portfolio, and it makes it much harder to recover once the market recovers. Longevity risk, like we mentioned. Longevity risk is simply the risk of outliving your money. As life expectancies increase and as you take on more risk, this ultimately results in you potentially outliving your money. High volatility. We see this when we look at the standard deviation of our most aggressive portfolio. Aggressive portfolios, which are heavily weighted towards stocks, as we can see here, a 90-10 portfolio, experience much larger swings in value over the short term. So for a retiree who might be relying on their investment portfolio to subsidize the income in retirement, this could, as you can imagine, result in a very negative outcome. Maybe the market collapses, or maybe there's just a temporary downturn in the market. But that so happens to be the time where this retiree needs to pull from that portfolio. Again, locking in losses, whereas if they were more conservative, maybe they wouldn't have had to. Emotional decision making. This is another risk with an aggressive portfolio. Obviously, with volatility comes emotion. Market volatility can lead to a variety of different emotional pitfalls. Seeing your nest egg lose a large percentage of its value in a downturn can cause you to sell at exactly the wrong time. And lastly, the last risk here that we'll address is reduced diversification. As we can see here, we have that 90-10 portfolio. So whether it's diversification across asset class, geography, or sector, odds are the more aggressive you get, the less diversified your portfolio gets. So this is something to be mindful of, especially if you're approaching retirement. So with all of this said, let's go into a conservative portfolio. A common myth out there is once you approach retirement or move into retirement, you must go into a conservative allocation, bonds, cash, or the equivalent of. And that is just not always true for everyone. Having a properly diversified portfolio moving into retirement that's aligned with your ultimate retirement goals, your risk tolerance, and your time horizon is much more important than just shifting your investments to a conservative portfolio. And in fact, a conservative portfolio, a portfolio that's too conservative, can actually have risks associated with it. Let's go over those risks. Well, jumping back into the plan, if we go here and we move our asset allocation to preservation, which for the sake of this example is the most conservative allocation, we can actually see here that we go from $2.2 million with our current growth allocation to ending our plan with just over $600,000. While our probability of success doesn't change much, we can see that this is a massive difference in the overall funds that we have at the end of our plan. So let's go into our investments and look at this asset allocation. If we move this to preservation of capital, we can see that here that the preservation of capital allocation is a 20-80 portfolio, 20% equity, 80% fixed income, with a hypothetical annual return of 4.9% and a standard deviation of 4.9%. So sure, while the standard deviation, how much your return deviates from that average, is much lower, so is your overall return. And now one thing you want to be mindful of, when you think about your retirement picture, and if you are relying on your investment portfolio to subsidize income in retirement, you are going to be withdrawing from this portfolio on an annual basis. So you need to think about, what is your withdrawal rate? Well, in this instance, if your withdrawal rate is over 4.9%, you will be tapping into your principal every single time you touch your portfolio. Now, if your withdrawal rate is less than that, then obviously your portfolio will continue to compound. Why? Because your hypothetical annual return is higher than that of your withdrawal rate, which is the funds that you're taking from your account. So let's go into the risks of a portfolio that's allocated to conservatively. The first is inflation risk and erosion of purchasing power. The most immediate risk here to conservative investing is that inflation will erode the purchasing power of your money over time. If you go into more conservative investments like bonds or cash that generate, let's just say hypothetically, 3%, but inflation runs at, let's say, 5%, the real return of your overall portfolio is ultimately negative. Now, for this example, we're assuming that inflation is 3%. We can see here that we have an annual return of 4.9%. Therefore, our real return for this example is 1.9%. So while we might be making a little bit of money here, you could see how this could be harmful to retirees on a fixed or slowly growing income in retirement. The second risk, similar to our most aggressive portfolio, is longevity risk. People are living longer than ever before. And if your portfolio lacks sufficient growth to keep up with the pace of inflation, then you will be eating away at your principal every single time you pull from your portfolio. Lastly, missed growth and compounding returns. We saw this when we were comparing the ending median assets. We looked at what happens if we go into a preservation allocation. And we saw that we finished our plan. At the end of our plan, we had just over $600,000. Well, if we would have left it in our growth allocation, we would have well over $2 million. So conservative investments like bonds, money market funds, or cash equivalents often have lower returns, obviously, than those growth assets. This causes retirees to miss out on what we call the power of compound interest, which is key to your long-term wealth creation. So let's dive back into our portfolio here. If we go back into the retirement analysis, we can see here that if we go with a preservation asset allocation, we will have $623,000 in median ending assets at the end of our plan. If we go with the most aggressive allocation, we will have $3.1 million at the end of our plan. And if we go with that growth allocation, the allocation that we have today, we can see here that we'll have about $2.2 million at the end of our plan. What I want to look at here is the withdrawal rate of our proposed plan. If we recall, when we look at our asset allocation, we have our hypothetical annual returns. And we saw that with a preservation allocation, we have a 4.9% annual return. Well, as we can see here, that once we get over the age of 82, we will be taking out more than 4.9% every year from our portfolio. This is why our median ending assets at the end of the plan are much lower than that of our growth or most aggressive growth allocation. So for Mark and Susan, this is something to be mindful of. Sure, it doesn't do much to the probability of success relative to their portfolio, but what if they were to look at their plan and figure that what makes most sense for them is either a balanced or moderate portfolio, where they have allocation to the preservation-like assets, think money market funds, bonds, or cash equivalents, but they also have a portion of their portfolio allocated to the growthier assets like stocks. So if we go with a moderate portfolio and we look at our investments here, we can see that a moderate portfolio is a 60-40 portfolio. 60% equity, 40% fixed income, with a hypothetical annual return of 8.2% and a standard deviation of 9.9%. If we go into our retirement analysis, we can see here that if we were to move forward with a moderate portfolio, we'd still have that 98% probability of success. And instead of $2.2 million at the end of the plan, we would have around $1.8 million. So when you think about your own retirement picture and what you have going on, it's important to consider the risks of having a portfolio that's too conservative or of having a portfolio that's too aggressive. You also need to think about, what do your goals in retirement look like? What does your life expectancy look like? What is your risk tolerance? And ultimately, what do you want to accomplish? Guys, your portfolio allocation and the investments that you have are the vehicle that you are using to help you achieve your retirement goals. If you want to create a plan just like this, I invite you to click the link in the description, create your DIY retirement plan, and you'll be on your way in no time. Thank you so much, and until next time, bye-bye.